Thank you, everybody. We are just, I'm going to share the results of the poll in one moment. We are just waiting for Odile to join, but I've just spoken to her team, so she'll be there in one moment. But while we do, I am going to share the results of the poll. So the question was, do you think the recovery package is a Hamiltonian moment and a meaningful step towards euro area fiscal integration? Well, we have an interesting share here. We have it at 58% think yes and 42% think no. It's pretty close. I think we should quickly go to our panelists and get their immediate reactions before I ask them to give them their wider thoughts on the future of the euro area and the steps towards recovery. So, Rolf, what do you think, Mr. Strauss from the ESM, Chief Economist from the ESM, do you think we are in a Hamiltonian moment? Yes or no?
Rolf, you're on mute.
Rolf.
Yeah. Okay,
so why don't we move to Pierre? Pierre, do you think we are in a...
Can you hear me now?
Yes.
Okay. Sorry, just very briefly. I very much understand the outcome. I mean, it's very clearly a significant step, the proposal that was made today. At the same time, I guess many of the respondents, as we all are still waiting on the final outcome and how big the result will eventually be. So that explains why it looks very balanced, but with a positive ground tone in it. So that's my view.
Pierre Blanchett, Head of Investment Intelligence at Mundi, please give your yes or no answer to, are we in a Hamiltonian moment?
Well, I personally don't think so. I think the results of the poll shows that it's slightly balanced towards one direction. I think it's a good sign, but clearly we went through this via various steps, very painful steps, let's say. So a little bit more is needed to get into this, I guess.
Thank you. Oscar, Chief Economist at Banco de España. Do you think we're in a Hamiltonian moment?
Well, for sure, we're in a very delicate and complex moment. I like the way Marco Butti coined this term, great fragmentation. For sure, we're facing this risk of great fragmentation. All the authorities I would say, are trying the best and are doing much. Of course, the monetary policy is providing a bold reaction. But and the proposal of the European Commission is a very serious one. If I may say, I'm a little bit concerned about many details that are pretty important in terms of the effectiveness of this program. And after hearing Marco Butti, I see that many of these critical details are still very much in a preliminary shape. So the success of all of this will depend very much on the details.
I think so. I think we can hash out those concerns a little bit later. So thank you for that. Odile Arano-Bassel, please could you give me an answer? You might not have seen the question, but the question we put to the audience was, do you think the EU recovery package is a Hamiltonian moment and a meaningful step towards euro area fiscal integration? I think we can also look at the proposal from Germany and yourself in France. So it'd be interesting to know yes or no. We'll come back to you for a little bit more detail on it later.
I mean, I believe it's a very important moment and it's a big step forward. Of course, it's a proposal and now it will have to be discussed by all 27 countries. We know that it will be tough discussion, but I think that in principle, it's a very, very large, very big step forward. So I don't know whether we should qualify it Hamiltonian moment because it's a package which is targeted for the crisis, it's temporary and so forth, but still, I think there is this proposal by the Commission, an agreement between France and Germany to agree that to finance recovery in the current circumstances, we need to raise very long-term debt and to allow for huge, giving very large amount of resources for countries that have been the most hit by the crisis is a very big step.
Thank you very much. And Art Hoban, the Director General for Financial Markets at the Dutch National Bank. Please do yes or no, and then I will come back to you all for your introductory remarks. Oh, Art, you're on mute.
Is this better?
Perfect. Yes, it is.
Okay.
Thank you.
I think clearly it's very important to counter fragmentation. I think clearly this is a very important initiative, European initiative, alongside the risk sharing through the ECB and other, but it's not a Hamiltonian moment, because there's no sharing of outstanding debts. There's no joint and several issuance of debt. Disbursement is not to national governments, it's to projects, it's to enterprises. So it's something totally different, which doesn't say it's not a welcome initiative.
Perfect. Thank you so much. I would like to I'd like to flesh out some of the themes that we were speaking in the first session, and then also look a little bit towards the future. And so first of all, I think it would be interesting for Rolf, please do make your introductory thoughts in the area of what are the steps towards recovery, and especially if we're looking at this not being a V-shaped recovery.
Indeed, thank you very much. So when talking about economics, obviously you always first need to remember this is about lives and about the health of people. But fortunately, in a way, research shows that focusing on lives and trying to preserve and contain the pandemic also seems to be the economically most successful strategy. Even though we are learning now, it's still utterly costly. And in terms of costs, you all know the Commission forecast. The forecast for this year for the recession is 7.7%. For the EU overall, it's 7.4%. And actually, market expectations are lower than that. And markets also market participants don't expect a V-shaped recovery, but a slower, whatever form, U-shaped, even though also nobody thinks that it will be flat. The point is that the depth and the duration of the recession will have implications for the long term. And there are 4 reasons for this. The one is that on firms' balance sheets, what is a liquidity problem may turn into solvency problem, and that may turn into insolvencies, in turn a reduction of productive capacity. Labor markets, we have been pretty successful in containing the impact so far, but there will be higher unemployment, that is clear, and then we may face hysteresis with longer term impact on the employability. The third element is that for the banks, they are now ready and do a lot in order to support the economy, but at the same time with bank balance sheet, there is actually the forward-looking, they have less capacity. And the final point is on the side of the public sector. Clearly, public deficits and debt will increase. And that means that in the future, governments can do something, but they will have to be more targeted in the support they can lend to the economy. And what emerges from that overall, one chart that is shown here, that you can see that thinks this forward and thinks about scenarii. And basically there are, in a way, 3 scenarii. The one is that actually Europe goes on a falling behind path, and that is the lower curve. I mean, it doesn't only mean that the recession may be deeper than in the baseline that the Commission presented, but also because of the implications that I just showed, that the long-term growth path is bending to the downside. So the euro area economy, or national economies that are hit that way, or regional economies within countries, really are starting to fall behind. The second scenario is resetting the clock scenario. We go back to the growth potential that we had before the crisis, but the economy is overall not able to recover fully the losses that were made. And the best scenario, obviously, is then the third one, which means catching up. And that means turning to a higher potential growth path that actually would allow for competing also with higher growth regions in the world. And that would require an effort of reforms on the side of all countries. Now, what does it take to get there? In our analysis, there are basically 4 points that would be necessary to go there. The first is that you need to avoid the strengths, the constraints that I mentioned before, and the 4 risks to actually materialize. And that means forward probably some targeted demand support and income support is necessary. The second point is to preserve competitiveness of the euro area and the EU countries in the global economy, and that will take some structural reforms. The third one is to rebuild the capital stock and work on labor skills in order to address the structural changes that the crisis may bring along. And the fourth priority is then to move from a framework of support to a framework that actually is supportive to those structural changes and doesn't overdo it by supporting sectors or elements of the economy that are not sustainable in the long run. And so that is also a quest to move into on the agenda of digitalization and sustainable green growth. Now, I think forward looking, it's very clear that the governments will be in the forefront of engineering that support and engineering those policies, no doubt. But at the same time, and Marco has emphasized this, and the previous panel has emphasized this, if you don't want to go into this scenario of great fragmentation, as Marco called it, then there is a need to work on convergence, and that is where the European initiatives come in. Yeah. We have heard about the first package that is supporting people, firms, and governments. That is done by the European Commission, by the EIB, and by us, importantly, on the health sector. And now we have discussed the what was announced today. And I think that's actually indeed a quantum leap in going towards a more productive route. Thank you.
Thank you very much. I'm going to swiftly move on to Pierre. Could you please talk about, from a financial markets point of view, what are the 2 key areas that you think that is going to be the key focus within the recovery? And it would also be interesting to hear your thoughts around the green and sustainable finance and the future that our economy might look like.
Yeah, sure. So I think that the 2 key areas, the first one is the relative freedom of the ECB versus other central banks. I think it's a topic we can discuss later on, but clearly the Fed seems to have more freedom to act. We are now talking about yield curve control in the US. It's quite impossible to achieve such a thing in the Eurozone. And there's always doubt about the ability of the ECB to really get things done in a simple way. I think the second point, which is probably more important, is that there are imbalances and asymmetry within the euro area. There are basically 3 of them. We know them, but as Marco Butti mentioned about great fragmentation, again, this is what markets are worried about, and so much divergences that we care about. So the first one is obviously the debt issue, is the relative size of deficits and the debt sustainability and the divergences we see within the euro area, with implications for the banking sector, but also in terms of divergences as far as capital allocation is concerned. The second is external versus internal dependency. It's something that usually we don't really care about, I'd say, within the euro area. Some countries are more obviously exposed to industrial exports, we know that. Some are more service driven, and those imbalances I wouldn't say they matter, but they do really matter now, because we went through confinement, because we had frontiers that have been shut, and obviously tourism and all those areas have been suffering more than others. So those imbalances are important as well in the recovery process. And then there's a third asymmetry, which I think that we knew we had, and I think the German Constitutional Court really raised again, is that there's a risk of inconsistency in the plan. In what is the plan for the EU, what is the plan for the euro area, and what are the underlying issues that we never really managed to fix and that are coming back whenever we are facing troubles like this. I don't think this is it's a negative outcome by nature, but just you can see that for markets, these are issues that basically generate three factors. First, it creates a larger discounts because of these imbalances versus other regions versus investment universe. It's a source of underperformance within actually the European Union or the euro area, relatively speaking, but also versus the bigger markets. And it's a source of volatility with the risk of actually losing retail investor or international investors, which basically are suffering from both underperformance, discounts, and volatility, and therefore are not so keen on coming back and investing. So I think these are very important things to bear in mind that can be solved, but those three, I think, imbalances are really, the issue for the recovery.
Yeah, thank you so much. We can come back, I think, to talking about green and sustainable finance issues, which I do know that you want to have a point on, and I think is a wider discussion about where what industries Europe can use to drive the growth in the future. But Oscar, I would like to come to you and talk about the role of the ECB and interplay between monetary policy and fiscal stimulus before we go to Odile, who can focus on that fiscal stimulus and the German Franco package. So Oscar, please do give your thoughts.
Yeah, thank you, Ellie. So I think that so far we may all agree that the Eurosystem monetary policy response has been quite bold and so far very effective in averting a major problem of financial fragmentation within the euro area, and in particular in the sovereign debt market, which is, as we know, critical for other segments of the capital markets. I'm sure that the commitment made by the Governing Council to recalibrate the instruments available for the ECB in the future as needed will be a very valuable buffer in the case that some adverse scenarios materialize. But all in all, my impression is that all these monetary policy measures, needed as they are allowing us to buy some time, and we have to take advantage of this time window to make a good use of this time. So time for what? I mean, I think it is a necessity to fix other elements, or if you wish, other forms of fragmentation on top of financial fragmentation that are likely to deteriorate as the crisis unfolds, that cannot be fixed by monetary policy alone, or even that cannot be fixed by monetary policy at all, and that require a European perspective and that necessitate genuine European tools. So in particular, on top of this possibility of financial fragmentation that so far has been quite successfully contained by the ECB, I am very much concerned about the possibility of fiscal fragmentation and real fragmentation, by which I mean fiscal fragmentation. It comes somewhat to my surprise that on the one hand, all international institutions, most analysts, commentators, academics, and so on, agree on the idea that what is needed now is a very bold, large response by national fiscal authorities to contain the effects of the crisis. But at the same time, we must be prepared to recognize that the capacity of euro area countries is very different across different member states. So I'm more worrisome. I think that we cannot rule out some adverse scenarios in which some countries that start this crisis from a weaker fiscal position may face some difficulties in providing the optimal level of fiscal support to their economies and to the most vulnerable sectors in their societies.
Thank you very much.
Okay.
I think we can come back. I mean, I would quite like to go to Odile to talk about that focus on the risk mitigation at an EU level and the proposal put forward by the Commission today. Is this proposal, it's a mixture of grants and loans, is this proposal in line with what you feel that the German and French proposal outlines, and what are your thoughts on the recovery fund?
Thank you very much. And really, I very much concur with what has been just said about the role of fiscal policy at the current juncture. I think it's very important, and the ECB made it very clear. They intervened very quickly in the crisis and providing a stabilizing role, but everything cannot be done and should not be done by monetary policy, and there is a big role for fiscal policy at a time where interest rates are very low, and what is needed is a fiscal stimulus. And indeed, I think our joint Franco-German proposal was based on the assessment that starting from a common shock, which is this pandemic, which has nothing to do with moral hazard, bad policies and so forth, but it's something which hits the countries, I mean, in the world economies at the same time, but with different strands, and has different impact on the different economies because of the structure, the role of tourism, the relative role of industry, and so forth, that we risk moving from a symmetric shock to an asymmetric, very deeply asymmetric consequences, also taking into account the different margins of maneuver at national level to deal with the consequences of the crisis. So this is why we believe that it's very important to have a very strong European response. And I must say that I want to flag the rapidity of the European response compared with what happened in 2008, 2009, and so forth. I think we all learned a lot from the previous crisis. Sorry, I'm just taking a little bit of water.
That's fine. Please, please do. I think what would be interesting is I want to ask. I mean, if Odile's back, are you?
So I'm back. No, sorry.
No,
no, so the reaction is much quicker and much stronger than when we saw in 2008, 2009. I think we learned a lot from the lessons and the need to have quick reaction to avoid negative development. This was the case with the first element of the package, which we should not forget, which is this 540 billion package agreed by the Eurogroup with the ESM, shown by the program by the Commission and the EIB. And on top of that, now the additional package, which is conceptually, as I was saying before, a big step forward in terms of EU capacities an EU instrument, and I believe that what the Commission has proposed is very consistent with the Franco-German proposal. The Commission is even going a step beyond with a proposal to have 500 billion grants and 250 billion loans on top of that, in order to support countries that would need to have access to additional financing. So I think that's a very comprehensive package with which is well targeted in terms of what are the key objectives we should look for: private support to private companies for equity needs or quasi-equity needs. I think that we all agree that we are moving from a liquidity crisis and the liquidity support to our companies to more solvency issues because of the lack of activity for 2 months or more than 2 months. And then there is this big support, this big new program, which will be spanned through member states' policies, and which attach, in a way, some strategic approach between investment and national programs, together with national strategy and reform. And I think that makes a lot of sense, and that's a way to make sure that there will be some kind of common approach at the EU level on the national strategy for the recovery, because I think this is a very important dimension that we will have to implement.
Thank you very much. I want to go directly to you and ask if you think that what is the feeling from the in the Netherlands around the EU proposal firstly, and then obviously I think you are very well positioned to talk about the central bank toolkit, and I know that earlier we have discussed also around the need to have structural changes for debt sustainability and a real key focus about when we come out of this crisis, a route back to normalization perhaps, and also the debt sustainability questions, which I then want to go back to all the panelists and ask around questions around debt sustainability as well. But Art, please do. Oh, you're on mute, sorry. Sorry, give us one moment. There we go, you should, there we go.
Okay, so you can hear me now?
Yes, yeah. Perfect. Yes? Apologies for that.
Okay, wonderful. Well, let me just say from a Dutch perspective, we hope that we've passed the bottom, the nadir of the crisis, and that we're now in the recovery phase of the economy. So if you split the crisis into 3 phases, the lockdown, the loosening up, and then the recovery phase, then I've understood the debate for this panel is the recovery phase. So we're looking beyond the immediate loosening up, and we're looking at the recovery phase. If you look at what the market is telling us, then the market is telling us that prospects are quite good. The markets have recovered enormously since February, but the markets have been it has not been a broad-based recovery. So some sectors have recovered even more than where they were before, and other sectors are still lagging. So what the market is saying is that we will need a very strong structural adjustment to get this repositioning of labor from one part of the economy to the other. And I think that's an important point of departure. If you then ask me, so what are then the 3 priorities moving forwards for the Netherlands? Then I would say one is sustainable debt levels. We believe this is very important. The second is a healthy financial sector. And the third is a green recovery. So if you allow me just 1 minute on each of these 3 initiatives. On the debt sustainability, we welcome the stimulus that has been provided, budgetary and monetary stimulus at the outset of the crisis. But don't kid yourself that with modern monetary theory that this debt is all free. It's going to have to be repaid. It's going to have to be made sustainable. I'm not being frugal. I'm not being Northern European. I'm being an economist, and we know that debt levels above a certain level, above 60 in the treaty, but most economic studies show that above 90% of GDP, greater debt is bad for growth, it's bad for incentives, it's bad for innovation, it's bad for enterprises. So we need to focus already in the recovery phase that we have to get some discipline to ensure that countries don't end up with unsustainable debt dynamics. Second, we need a healthy financial sector. We've all built up a lot of buffers in our financial sector. Certainly in the Netherlands, we did this, and we freed a number of these macroprudential buffers 6 weeks ago. So we released the systemic risk buffers for our biggest banks, and I know a lot of other countries have reduced the countercyclical buffer, and there has been relief in prudential measures. But be careful, because we have a real economy in crisis, and we have to avoid the financial sector also being a contagion and also being infected, and because then it will be even worse. The crisis will be much worse than where we are now. So we are urging banks to give payment holidays, to give new credits, to extend new debts, but we have to be prudent here, because we have to make sure the banks stay healthy. So if you ask, what are things to do this? First, we need to avoid inefficiencies in banks. We need to sort of streamline banks a bit. We need to break the sovereign bank nexus, which has become much more intense over the past months, and we see the correlation between the CDSs of banks and governments right up to where they were in 2012. And we need to develop non-bank financing, and we need to develop the capital markets union. Finally, green recovery. We really need a Paris-aligned green recovery. I mean, the COVID crisis has shown us that we can rise to the occasion of a crisis. I hope we can also do this with the climate crisis, and that we can avoid creating now with new credits the stranded assets of tomorrow. So we really need to move to Paris-aligned behavior. We need to move to carbon dioxide pricing. We need to move to a green economy. And I think the energy transition can actually be one of the things that helps kickstart investments and really jumpstart the economy. In short, we need a move to sustainable green economy with a healthy financial sector and sustainable debts. Thank you.
Thank you very much. We have questions coming in from the audience, which I will move on to. So please do keep them coming into that question function. Oscar, you seem to have some thoughts around what Art was saying. Am I correct in that? It would be interesting. We also had a little smile from Pierre. So I want to come to you to perhaps talk around that question of debt sustainability and how we move exactly. We're talking about steps towards wider recovery and where Europe might be in a few years' time. So Oscar, do you have some thoughts?
Okay, so well, first of all, I think it is undeniable that I have a concern about debt sustainability in the euro area. This is for sure. This is more a pressing issue for some countries than for others, because the initial condition is, and the economic prospects are heterogeneous within the euro area. The ECB published, I think it was 2 days ago, the Financial Stability Review, and it was rightly pointed out that one of the main concerns looking forward in terms of financial stability is the high level of public debt. So I cannot agree more with Arne about the seriousness of this factor. I share most of the thoughts put forward earlier by Arne. So let me focus on some very basic issues, just looking at let's say the arithmetics of debt. No? So there are 3 aspects in which we have to act in order to keep our debt sustainable. First of all, we have to be very clear, very credible in communicating what we are going to do in terms of fiscal consolidation after deploying all these measures to counteract the crisis. It is, I agree with those that think that it is the time to do whatever it takes in terms of the fiscal response, but at the same time, we should be ready to think about what we are doing in T+1 when the recovery starts. And the answer here, at least qualitatively, is for me is very clear. We have to be very forward-looking and to communicate in a credible manner how our governments are going to tackle the issue of the debt in the future. So this will be necessary in the future, but it will be necessary in order to maximize the stimulus provided right now, because we know that for this stimulus to be effective, it must be the case that the whole path of public finances is credible. Now we have to keep a positive differential between G and R, between growth rate and interest rates. In terms of growth rate, we are facing many challenges looking forward. The focus put today on the European Commission strategy, I think, is the right one. I think it is the time to talk about measures to stimulate growth. It is the time to talk about investment. It is the time to talk about structural reforms. We have talked about this many times over the last decade. And my feeling is that over the last 5 years, at least, the Euro area countries, especially those who need more these reforms, lost a little bit of momentum. We cannot wait until the next crisis to do this homework. At the same time, we have to recognize that this kind of reforms take some time to pay off. So the sooner we start, the better the outcome. And finally, on the interest rates, ideally, the Euro area as a whole should be able to finance itself and an interest rate that is close to the, let's say, the equilibrium natural real interest rate of the area, which according to some estimates is very, very low, perhaps even is negative. So in order for all countries in the euro area to tap financing at these rates, we need to meet some conditions. One, as Anne was saying, we need a healthy banking system. I mean, without the banking system, it is very difficult to think that everybody in the euro area can finance itself at a decent interest rate. We need to avoid financial fragmentation. And again, I mean, the ECB so far is doing the right job, but there are some questions looking forward, as it was discussed in the previous panel. And on the side of monetary policy, I think that for the time being, there is some consensus that the dominant force in terms of inflation coming from this shock goes into the negative direction. It seems that the inflation expectations are going down. And taking into account the commitment of the Governing Council, it seems to me that interest rates, the policy rates, are going to be at the current levels at most for some time. So this should again help in order to do the proper homework to act on the growth strategies and on fiscal consolidation strategies.
Thank you very much. We have a question from Julian Callow, so an audience member, for Rolf. So under the European Commission plan, the European Commission would become a much bigger borrower than the ESM has been so far. Is it going to forge that path independently of the ESM, or will it be able to utilize the ESM's own experience in tapping markets?
I mean, we have just been presented with the proposal for the European Commission, and indeed it entails a great deal of more issuance activity of the European Commission colleagues. We have great experience. We have ramped up the ESM at the time. There are at this stage no discussions that we would help the European Commission in taking up that task, and it's effectively it would be very difficult in a way also to mix balance sheet. That doesn't work at all. But we will see how practically we can go forward, and if there were a chance to just be helpful, we would obviously be willing to do so.
Thank you. In the previous session, there was also, we had a short discussion on the implications of the ECB buying the European Commission bonds above the 33%. So that being part of the offer from the European Commission. Are there wider thoughts for that? And what would be, in fact, David Marsh has just put that question as well, so OMFIF chairman, perhaps more eloquently than me, but basically towards Art, would you be happy at buying up to 50% of the allocation of the new bonds of the European Commission in the next 2 to 3 years, as allowed under the ECB?
This is a tricky question because it's partly a legal question, and you know, there are certain clauses in the treaty which we have to be very careful with and which we need to respect. And until now, the threshold has been determined according to what is needed to avoid the ECB, after it has purchased a certain bond, being able to block a restructuring and thereby to providing monetary finance. Now, I know that consideration is different for a bond that is issued by the European Commission than by a national state, but you know, lawyers would have to look at this. My own view is that institutionally, it is certainly better to have a federal counterweight to the ECB and to intervene in a much more unified manner at the European federal level than to do it through national government. So I think from a conceptual institutional point of view, the answer is yes. From the point of view of the treaty and avoiding monetary financing, I hesitate. And the third point I would like to make is that all this bond buying or whatever, we really need to we need to move to an economy that doesn't need this anymore. So you know, we're all thinking the whole times of all these totally unconventional extreme measures, but we need to also think of what can we do to strengthen the structures of the economies and to get the growth on a much more healthy standing than it is now.
Thank you. I want to follow up to the rest of the panelists to see if anybody else has a thought on this. David has a secondary part to his question, which I'd like to put to the panel. Would the national central banks in the Euro system follow different practices in the PEPP reinvestment in the next few years? So Germany and France may allow net redemptions, France, Italy and Spain will undertake maximum reinvestment, and this way allow the maximum flexibility under the capital key requirements as landed in the ECB pronouncements within, we're talking about the PEP program. So I think they have given themselves flexibility within the capital key. So Oscar, do you have any thoughts regarding this?
Well, the only thought I may have on this, I mean, the only thing I can say is that the ECB Governing Council has not made a decision about the reinvestment policy on the PIP. So there is little to say about this as of today. Let me say something, by the way. According to the current calibration of the PSPP and the PEP of the ECB, the issuer and issuer limits for EU supranational bonds, which I understand would be the category within which the new bonds issued by the European Commission, is not 33, it's 50%. Provided they get a good rating, which I assume it will be the case.
Yeah, that was alluding to. Thank you very much. Going back to perhaps to Odile and also Pierre, you might want to come in on this. So we have a question from Giovanni that he asks, to achieve the first best solution, should the fiscal stimulus focus on the sectors that can provide the crisis, that survive the crisis, and let the more contact-intensive sectors close? Is this the right way to spur the process of creative destruction? So essentially, where should we be investing this money, and should we be looking at it in sector focus in the expectation that social distancing will continue? Odile, please do offer your thoughts here.
Thank you very much. First of all, I wanted to come back on the timing of the recovery and the timing of when should we start phasing out measures and so forth. And I think that it's very early to speak about normalization. We are still at the very acute phase of the crisis. I think the figures for 2020 will be very, very negative for all European countries. So I really believe that we need to avoid the mistake of willing to normalize too quickly. We will have to normalize. We have to ensure that sustainability over time and to get out of exceptional measures and so forth. But it's very much too early to discuss that. It's important to keep the anchor and the prospect, but we need to be very careful about the timing and to draw lessons from the past in this respect also. In terms of where should we spend the money, I very much agree with what was said about the green focus, and that's one of the very good elements of the Commission proposal. I think that this is a way to address both challenges, the climate challenge that we all agree we need to address, and the need to kickstart the economy. So investments targeted to the green transition will be key, and that should be one of the priorities. Then there is a very difficult question all governments will have to face, which is until what point to support sectors which face a difficult situation, which could be and which is expected to be limited in time. And for example, this could be the issue of the aeronautic sector or automotive car industry sector, where we probably will have a sort of slowdown, very marked slowdown and a slow recovery, but on which probably activity will come back and maybe at a lower level, but still. And you may need to invest and to continue to invest to keep the technology, to keep the know-how and so forth, and the human capacities. But on the other hand, you don't want to block all, the shift in the economy that will be needed because of structural changes in the economy. And this is a very difficult balance to find. Of course, there will be a lot of pressure from sectors requesting support and so forth, but we need at the same time to be able to accompany these sectors in weathering the slowdown while not blocking the shift. And I think that a joint European approach on that will also be very useful.
Thank you very much. I think that it'd be interesting to hear from Pierre on this point from the financial markets perspective. I want to quickly, though, ask a related question that has come in from our chief, the OMFIF chief economist, Denai. She asks, she follows it on from Art's concerns about debt sustainability. What is the preferred measure of assessing sustainability of debt? So debt to GDP also includes the denominator GDP. So focusing on growth should also be a priority to ensure debts remain sustainable. So absolutely agree on the risks of stranded assets, but what are the risks in your view and also the wider panelists' view on the Commission's plan which channel funds to green recovery, digital transformation and strategic industries? Again, looking to the future. So really focusing on if we can raise the growth and if we can raise the GDP, does that strengthen the debt sustainability in and of itself, with also being aware of the debt being taken on? So I think that would be interesting to put to Pierre in a financial market sense about what the concerns are perhaps in those acting in the markets. Yeah,
so it's a good, you want me to start on both questions, right? Okay. Yeah. So look, on the debt sustainability, the obvious answer, at least is nominal growth versus interest rate and the speed at which you're able to reimburse your debt. This is what Ed mentioned, and I don't think there's any other way. I mean, it's a simple equation we need to look at. There's another caveat though, is that who owns the debt and who you're asking for actually to finance yourself. Obviously, if it's internal, as is the case for the party of Japan, or whether it's external, and it's obviously a different story. Whether you have a central bank which is able to keep timing and therefore manage the time horizon of this debt or not. So obviously, therefore, the question gets slightly more complex. But eventually, it's all about, I think, sustainability of the growth path and your ability actually to do the reform you need, or to tactically actually put the economy back on track, as we are supposed to do with the fiscal policy. But I think to the first part of your question, you're referring to sort of Schumpeterian vision of the economy, where you are supposed to lay down sectors that are in difficulties and so that the others can thrive. As I would fully agree with what Odile Renaud said. I mean, there are sectors that are really common good. They are needed actually for the economy, not only for its people, but also for its partners. So it's obviously the case for infrastructure, everything which relates obviously to transportation, but also digital infrastructure and so on and so forth. So, and tourism, by the way, because we like to go and visit Spain and we like to go and visit other countries. So it's part of the common good, and those sectors shouldn't be put in the bin just because they are not profitable on the way out. My last point would be on, we talked about the green transition, which I guess is key. We also need to obviously think about what we can do with digital transition. I mean, we are doing this conference remotely. We've learned a lot on how we can work better on a digital form and how we can gain a lot of efficiency and save the planet as well, not traveling, taking those planes and so on and so forth. So I think there's great hopes in this space. But also, you know, I think the theme going forward will also be on re-onshoring. There's a regionalization process going on. People won't agree anymore to have drugs basically produced for 95% in China and not available in Europe. They want masks to be produced in Europe. They want, you know, their own pharmaceutical industry to be independent, and so on. Actually, for the supply chain, so the regionalization is a key theme going forward, and a key theme where actually the EU plan is so important, because this is a success factor for the European Union and its economies going forward. And my last point would be that we tend to focus on the green part, right, in the E of the ESG. But I think the next decade, which badly started actually, is about the S. It's the S, is the social aspects, which will be actually the investments of the future. This is what shareholders, what voters, what all stakeholders of the economy will be asking for. And it's not being, you know, having a political view on this. It's an obvious choice that we have to make collectively, and this is a great opportunity for investors. And I think it shouldn't be seen as a burden in some aspect. It's actually the opposite. And I think the S of the ESG is a key parameter and a key factor for investment going forward.
Yeah, thank you very much. Rolf, do you have any thoughts on that sustainability and that focus on the green and also social investments driving growth across Europe?
Yes, so on that sustainability, you may remember that also as part of the preparation for the pandemic crisis support that of the ESM, there was an assessment of that sustainability and other macroeconomic criteria by the European Commission. And there it says, and the European Commission judges that that is deemed to be sustainable for all Euro area countries. Now, I think there are some fundamental factors here and that make the comparison also with past benchmarks like 60% and 90% somewhat questionable, because we are in a new environment, an environment now where this I minus R interest rate and growth are such that probably we can sustain much higher levels of debt than we could in the past. That is just a consequence of this fundamental shift that we have experienced over the past couple of years. And it's also not warranted you only focus on the stock, but also focus on the flows. And as long as flows can be kept at bay and can be managed, the situation is also manageable. But at the same time, it's clear that also that sustainability assessment is predicated on the willingness of countries to run prudent fiscal policy and to follow the fiscal rules. And that is a high bar that is imposed here. And it obviously raises challenges also for governments forward-looking. But I think overall, in my view, higher debt levels, we will have to be used to higher debt levels, and we can get used to them, but we need to live up then to the responsibilities. Now, on the sectoral question and on the future development, I can understand the question, what will be the future growth sectors? And there's a lot of strategic thinking also in the Commission proposal. But to some extent, I think the main challenge is also still to lay the groundwork, and then the economy needs to develop. And here, I mean, what differentiates this crisis from the past crisis, that it very much affects the service sector. One of the key points that is left on the agenda of the EU development is actually to have a common market for services. And I think this is one of the areas where also this request to work on a level playing field should be taken very serious. And we do this, we work on service union, we work on capital market union, and we work on a more integrated banking sector. And then a lot of this issue, what will be the most profitable, most productive sector, will solve itself, which is actually what should happen in the economy. In the course of that, there will be the need to also handle the investments that now governments are doing in companies in order to rescue those, and that will have to be handled carefully. So the denationalization of companies, that will be done in the meantime.
Thank you very much. That actually moves me on to the final question of the whole afternoon. So thank you everyone for joining us. The final question is from an audience member. And then when we have answered it, I will hand it over to OMFIF CEO John Orchard to do a very brief wrap up, and another audience poll. We'll ask the same question that we asked at the start of the afternoon to see if anybody's thoughts and opinions have been shifted or changed. So I think that would be an interesting understanding of what we have discussed over this afternoon. So the question, which I would like swift answers to, is there is investor concern about the health of the euro area banking sector over the next few years as NPLs potentially rise. Will they have sufficient capital to grow lending? So should not part of the recovery fund be allowed to help provide sustainable more capital for banks? Also, could the recovery fund be applied to part indefinitely the ECB so it could buy bank loans in the future? So essentially, what are the support for banks within for the future? Odile, could you offer your thoughts?
Maybe,
on this?
yeah, thank you very much. To start with, I think it's very very clear that the banking sector in Europe starts from a much higher position than in the previous crisis. So the capital is much higher, and so there is no short-term worry. Of course, there is always the risk of NPL with a big slowdown we are facing. But it's important also to acknowledge that a large part of the financing, the new financing provided by the banking system, at least that's the case in France, but I guess it's the case also everywhere, is now guaranteed. You have the banking sector benefit from guarantees from the government. So the increase in the recent increase in lending is in support. Is supported by the government with guarantees in order to provide liquidity to companies. But of course, we will have to be very careful and alert on this issue of NPL. And in my view, the strategic investment part of the Commission proposal could be indeed be part of a broader thinking about how to deal with this NPL issues. But I think that banks are at that stage well equipped, and I do not see major problem ahead.
Thank you very much. Does anybody else have any burning answer to that question? Support for the banking sector with the rise of NPLs? Please.
Yeah, well, first, I'd just like to give my 2 cents on the question previously, just 1 minute. And that is the issue that as long as G, the growth rate, is higher than the interest rate, then debt is very sustainable. That is true, and that is important. And it's very welcome that interest rates are lower. But high government expenditures and a big share of an economy belonging to the government will impact G downwards and I upwards. So there's a second round effect which needs to be taken into account. And if we want economies to grow quickly and to be vibrant and to be innovative, we have to provide the scope for that. That brings me, and on the debt sustainability also, we need to take account, countries need to be in a position to be able to absorb a crisis like this one. And you'd want all countries to have the scope to do that. And I think moving forwards, we need to look and take on board that lesson. On your question of banks, I think European banks overall are solvent, but they're probably not very efficient, and the profitability is not high enough. So that's something we need really to do something there. If you then talk about the solutions, I have some hesitation with the way in which people then immediately come with all sorts of proposals to have governments and to have public sectors taking part in the banks. We want to separate these two sectors. So, get private money in there or sort it out with private incentives. That's what happened in the US in 2009 when they had a banking crisis. 21 banks had insufficient capital after the stress test. 20 of those 21 were able to cover the shortage with private capital. Provide them the incentives to do that, and then sure, Europe will have a very vibrant and very healthy banking system.
Okay, thank you very much. I do want to close. I think that we can continue this conversation, and I can see that, Oscar, you're potentially bristling. So, but I do want to thank everybody for joining. We've gone slightly over time, but I believe that we've kept each of our sessions other than the first session, but I think it was a very interesting afternoon. So I want to thank all of the attendees for joining and everyone for asking your questions, and also all of the speakers. I'm very pleased to hand over to John Orchard, who is our CEO at OMFIF, who'll be able to do a quick summary and also ask that all-important audience poll to see if the feelings have changed on how we think this crisis will impact the euro area. So thank you all very much for joining us. John, please do.
Thank you, Ellie. Thank you very much, everyone. It's been a fascinating afternoon. We're going to run the poll again that Denai ran earlier, where we asked whether Europe is being strengthened by the crisis. So while we get that poll ready, I just wanted to add my own personal reflections. David and I and others have had lots of on and off the record conversations around Europe since the beginning of the crisis, and the tone of them has definitely improved. So there were quite worrying and depressing conversations early on with real animosity between some countries. I'm sure I don't need to elaborate, and that has been replaced by lots and lots of complicated questions that you've looked at this afternoon, but nevertheless, certainly from my perspective, progress. So thank you very much to all the panelists this afternoon for your contributions. Thank you, Amundi, Pierre and colleagues for helping facilitate this. And thank you all for listening. So let's conclude then by rerunning the poll. Helen or Ellie, please could you put the poll up, and we'll see if we change any hearts and minds today. And let's reveal the answer. Well, how about that? So I think when Denai asked the question, it was 2/3, 1/3. And over the course of the afternoon, as people have heard the details, their optimism has increased. So I think that's a very heartening note to end on. Lots and lots of work ahead for lots of people, but a very promising start for the cohesion of Europe as a result of the crisis. So thank you very much indeed, everyone, for joining. Thank you again, Amundi, for helping us put it on, and we very much look forward to seeing you all again soon, virtually or indeed in the flesh. Thank you very much, everyone, and goodbye.